What happens in the U.S. auto sector is usually seen by economists and financial advisors as a presage to what will happen in the U.S. economy, and we have to admit that conditions are getting critical right now. Several key data sets are pointing to an ominous inflection point and a crushing auto loan crisis as consumers can't afford their car payments, and the rate of repossessions continues to rise. Experts say this is also an indication that a full-blown recession is near, and that U.S. drivers should brace for a turbulent 2023 with interest rates expected to soar even higher and souring credit conditions at major lending institutions. We have a lot to cover today, but before moving on, we kindly ask you to support our work with a thumbs up and don't forget to subscribe. U.S. consumers are tapped out, and according to credit ratings firm Fitch, a consumer recession is officially here. The latest data released by the company exposes some troubling developments now happening in the U.S. auto sector. Americans are using unprecedented amounts of debt to fund record car prices. Numbers released in December showed a dramatic spike in the number of new car loans, with the average loan increasing by more than $2,000 in a single quarter, from just over $38,000, a record, to $40,155, a new record. Evidently, the reason why new car loans have hit record highs is simply that new car prices have also soared to all-time highs. But the discussion of whether record new car prices are the result of easy record credit, or whether record new car loans are simply following the explosive surge in car prices, seems irrelevant at this point. Instead, let's focus on something even more alarming: the massive surge in the average interest rate on new 60-month auto loans. According to Bankrate, as of January 27th, the rate was just over 6.67%, almost doubling since the start of 2022 and the highest in 12 years. It is this surge in nominal auto debt, as well as the unprecedented spike in new auto loan rates, that we believe has finally pushed the U.S. car sector to the infamous Wile E. Coyote point of no return, wrote financial analysts with Zero Hedge. Less than a month ago, citing an NBC report, the analyst noted that a soaring number of consumers were falling behind on their car payments, a trend which will only accelerate in 2023, in a sign of the strain soaring car prices and prolonged inflation are having on household budgets, they wrote. And it looks like their predictions are spot on. At the start of the pandemic, the rate of repossessions dropped when consumers got a boost from stimulus checks, and lenders were more willing to accommodate those behind on their payments. In December, the number of people behind on their car payments approached pre-pandemic levels, and for low-income consumers, the rate of loan defaults exceeded where it was in 2019. Things have escalated so quickly that today, more Americans are falling behind on their car payments than during the financial crisis, Fitch reports. This month, the percentage of subprime auto borrowers who were at least 60 days late on their bills rose to 5.67%, up from a 7-year low of 2.58% in April 2021. That compares to 5.04% in January 2009, the peak during the Great Recession. Consequently, the number of car repossessions is rapidly climbing all over the nation. In an interview with Bloomberg, 21-year-old Kobe Hatch said that he was surprised when he couldn't find his 2013 Dodge Journey outside his Chicago home last month. Despite the shock, he immediately knew it had been repossessed because he hadn't made the car payments in many months. Without his vehicle, Kobe couldn't work as a delivery driver for Amazon anymore. Just before Christmas, he got fired. Now he's struggling to pay his rent, can't afford groceries even with food stamps, the report reveals. It's been very stressful for the past few months, he said. Inflation has really taken a toll on people. Just like Hatch, millions of Americans are now facing auto repossessions, a worrisome sign for the U.S. economy. Over the past couple of years, an extraordinary surge in used car prices have forced buyers to take out bigger loans for their vehicles. During the pandemic, the monthly payments may have seemed reasonable as stimulus money was still running its course throughout the system, the labor market was tight, and stocks were at record levels. But conditions have deteriorated since then, and now inflation is squeezing people's finances and leading business owners to start conducting mass layoffs. Many buyers who purchased their cars just 1 year ago didn't anticipate that spiking interest rates would make their car payments skyrocket and in many cases get out of their reach. Cox Automotive data indicates that the average new auto loan rate was 8.02% in December, up from 5.15% a year earlier. For subprime borrowers, that rate is significantly higher. Hatch, who is subprime, says that the total monthly bill for his car hit about $1,000, including the cost of insurance, due to a whopping 26% interest rate. Even if he could find a way to get enough to get his car back, having to pay around $1,100 just for the repossession fee, there's a high probability that he won't be able to make the payments in following months, particularly considering that he's now unemployed. Auto auction company Manheim reveals that the rate of repossessed cars increased 11% in 2022 compared to the prior year. It is still rising fast, and unless something major changes, it'll soon overtake most recessionary benchmarks, the analyst highlighted. Typically, it takes 2 or 3 consecutive missed payments for a repossession to occur. One of the biggest problems is that once the vehicle is seized, the repossession can affect the borrower's credit score for as long as it stays on the credit report, which usually extends for about 7 years, according to Experian. Another subprime borrower, Joseph Fields of Fort Worth, Texas, says that he also missed his last car payments, and that has taken a toll on his credit score. With his monthly bill at $556 for his 2021 Subaru WRX, the 25-year-old told Bloomberg he too woke up to an empty driveway a week before Christmas. The repossession and tow fee will cost him $1,600, almost the total sum he owes in back payments. Fields is concerned about how this will affect his financial future, particularly his dream to purchase a home one day. He estimates that the repossession shaved about 40 points off his credit score. When it comes to people my age and younger, our credit is still new, so it's more difficult, and then when stuff like this happens, it screws us over for the long run, he says. Similarly, San Antonio native Sia Zerko is currently trying to negotiate with her lender so her 2013 Honda Fit won't get repossessed. In the meantime, she's hiding it. The 53-year-old technology student splits the monthly bill for the car, nearly $180, with her roommate. But after the roommate lost his job and prices for groceries and everyday items became way too oppressive, there just wasn't enough left at the end of the month for the car payments. Zerikor is trying to make extra money with second and third jobs, but she often feels hopeless, she said. Our money doesn't go as far as it used to. I don't see prices going down, so the only relief I see is when I get my degree. The financial squeeze has been disproportionately impacting low-income buyers looking for budget vehicles, which have been particularly hard to find. Until 2019, those consumers would have purchased a used car for $7,000 to $15,000. Today, they're having to spend $20,000 to $25,000 for the same type of vehicle. The Consumer Protection Financial Bureau reports that among dealers that cater to subprime and deep subprime consumers, the average listing price on their cars has almost doubled since the beginning of the pandemic. That near-prime and subprime group of consumers, they're getting hit very, very hard by inflation. That group of people did not have much disposable income. They had to finance a more expensive car, and then they got hit with prices going up overall. There's just a lot of stress, the agency noted. On top of that, one industry insider that has been featured in the New York Post speaking on condition of anonymity exposed that a major subprime lender is already in big trouble. Capital One released its Q4 '22 earnings on Tuesday. The company missed revenue targets and reported a net income of $1.2 billion, which is half of what it was a year ago. Adjusted per-share earnings are at $2.82, which is significantly below analysts' expectation of $3.87, the source unveiled. The net charge-off rate for auto loans was 1.7%, up from 0.6% last year. Auto loan originations were at $6.6 billion, down 20% year over year. Credit tightening and rising defaults are all evident, the insider stressed. There's a lot of internal turmoil happening inside the bank. In the words of a person familiar with the situation, never has there been so many high performers moved between divisions. Not just any divisions, he continued. Turns out that many leaders have moved from the Dealer Technology and Products division to the Help Me Catch Up division. This division's purpose is to work with delinquent customers. The source says that in the past, the department has been largely neglected, raising the question of why would Capital One suddenly decide to stifle innovation and reshuffle its workforce. I see it as another affirmation of what to expect from the market in the coming year. Significantly propping the services division by the top automotive lender tells me that delinquencies are rising as consumers are struggling to manage their auto loan payments, he explains. Cox Automotive's data supports his thinking. Auto loan performance deteriorated in the past month, with loans delinquent by more than 60 days up 26.7% from a year ago. Moreover, credit conditions are souring at major lending institutions as banks brace for soaring delinquencies, defaults, and catastrophic write-downs. New loan originations have also collapsed not only because of higher loan standards, but because most Americans suddenly realize they can't afford monthly payments at the current rates. I dare to think what'll happen to people who are signing up for new loans today, said Ivan Jury, Director of Insights at car buying website Edmunds. The situation is not going to be better when we see these payments so high. These repossessions are occurring on people who could afford that $500 or $600 a month payment 2 years ago. But now everything else in their life is more expensive, Jury added. That's where we're starting to see the repossessions happen because it's just everything else starting to pin you down. At the same time, for those in the repossession business, it's been almost impossible to keep up with the surge in new business, says Jeremy Cross, the president of International Recovery Systems in Pennsylvania. The executive affirmed that he can't find enough personnel to meet the demand or space to hold all the cars his company has been tasked with repossessing. Right now, it's really the perfect storm, Cross outlined. Over the last 2 years, vehicle prices were inflated because there was no new car supply. People were still buying like crazy because they had a lot of stay-at-home cash, they had inflated credit scores, so it was like a recipe for disaster. It's very obvious that this will not end well. A tidal wave of delinquencies is on the horizon, and banking institutions are already preparing for the worst. The implosion of the U.S. auto sector is coming, and it is going to be spectacular. Thank you for watching. We look forward to your comments under this video.